today's video, you're going to be looking at the Walt Disney Company, one of the companies that really got my attention as the overall market has been declining from the past few weeks. So in this video, I want to break out all the business and actually see if it is a good or a bad investment. I want to start breaking the financials. So as you can see, the stock has been really struggling, and the company now is standing at a P ratio of about 14, which is really lower compared with the 5-year average of the Disney company. So for sake of this video, to make my calculations, I'm going to use a P ratio a little above this one, 16 P ratio, being a little bit conservative. So if we analyze just the past financials of the company and say that Disney is going to perform just as well as they did in the past 4 years, so without considering future growth or future losses, we can guess if the company is actually overvalued or undervalued. And basically what we need to do is make the average of the earnings of the past 4 years and then multiply that by 16 was the P ratio that we established, and we get the market cap, and then divide the market cap by the shares outstanding, and we have the fair value of the company, Disney company, which is a bit higher than the company is trading right now. So as you can see, based on these calculations, even with me being so conservative, we can see that Disney is trading at a very low price. In order to be more accurate, we need to look at some more details. The P ratio, the trailing P ratio is about 20 and the forward P is about 21. Looking at profitability, they have a margin of about 15%, which is normal and acceptable for the industry. They have a good quarterly revenue growth year over year, about 36% from the past year. However, the quarterly earnings growth is decreasing, but is actually an explanation for this. If you look at the debt, they have a huge amount of debt, and I think this is the worst problem that I see in Disney stock, because they have 6.83 billions in cash and 51.93 billions in debt. Although this debt came from the explanation that I will give you, basically from the same explanation as the quarterly earnings growth, this is way too much debt, and given the situation right now is a huge of a problem for Disney. Huge cash flow, as you can see here, operating cash flow around $6 billion, and the leverage free cash flow being 8.5. Huge numbers. Very few companies can make these amounts of cash flow, but Disney is one of them. So looking at the dividends, we can see that Disney is a dividend stock that pays us $1.76 per share. They have been increasing their dividends throughout the years, which is really good, and having just 31% of payout ratio is just phenomenal. If the business continue to perform, I could easily see they continue increasing their dividends moving forward. A very good aspect to consider. Looking at the trend of the revenue as well as the operating expenses and net income, we can see that the revenue has stand on a very pretty good trend. The operational expenses, they have been increasing. They need to manage this well in order to become even more profitable, because if you average these numbers here, it's a flat 10 billion, actually 10.5 billion, and I think Disney could really be much better in this department and could really increase their margin of profitability moving forward. Now I'm going to explain that amount of debt. What actually happened was the acquisition of the 21st Century Fox. Disney acquired this company about 1 year ago and carried it with it all the debt they had. I want to show you how big was the 21st Century Fox and how much money it cost for Disney to acquire. As you can see here, Disney is a very huge company comparing with the industry and all the competitors. Disney raised its debt $6 billion on Friday, March 20th, and as they want to be prepared for this whole situation, taking advantage of the low interest rates. And this tells me as an investor that Disney is not that comfortable going through these times, and make me a little bit unconfident when looking to invest in the company. So I think this is a red flag for investors and could potentially generate some more sales on the stock for the week ahead. And in the end, obviously, I'm going to share my thoughts and give a little bit my opinion in this whole situation happening in the world and the direct impacts on the Disney business. Now, for us to understand better the business itself, we gotta look at the segments that Disney operates in order to become aware of the Disney company. Disney operates in 4 segments, starting with the media networks. All the big media networks like ABC, Disney Channel, National Geographic, they earn money mainly on advertisement, affiliate fees, and others. So it is effectively a huge source of income, generating about 35% of Disney revenue. They also operate in the studio entertainment. So if you look at these, several very well-known movies like Star Wars, Marvel movies, Pixar, and a lot more are included in these departments. And he's responsible for about 16% of the revenue. Huge department. Obviously, the parks and experiences segment. All of you know what this is. Disney has parks pretty much all over the world, and others like cruise lines, trips. This generates about 37% of the company revenue. And last but certainly not least, the direct-to-consumer and international department, which is a huge business model, and for me the best one, or must say, the one that has most potential to grow. Therefore, I would like to give you guys some more insight so you guys can understand better what this actually is. So as DTCI deploys leading-edge world-class technologies to drive content in ways that sets new standards, delights consumers, delivers value to advertisers and distributors, and creates future growth opportunities for the Walt Disney Company. It is also responsible for the Walt Disney Company's direct-to-consumer business globally, including the ESPN Plus sports streaming service, programmed in conjunction with ESPN, Disney Plus, the upcoming Disney-branded direct-to-consumer streaming service, Hotstar, the leading over-the-top streaming service in India, and the company's majority ownership stake in Hulu. Disney streaming services like ESPN Plus, Disney Plus, NHL, BAMTech Media are the main ones. Fans subscribe to ESPN Plus for just $4.99 a month or $50 per year. It is also available as part of a bundle offer that gives subscribers access to Disney Plus, Hulu, and ESPN Plus, all for just $30. Disney Plus is dedicated streaming home for entertainment from Disney, Pixar, Marvel, Star Wars, National Geographic, and more. Disney Plus is now available in the US, Canada, the Netherlands, Australia, and New Zealand, and is expected to be in the most markets within the first 2 years. The service will be available on a wide range of mobile and connected devices, including gaming consoles, streaming media players, and smart TVs. That being said, until now, the TCI is just responsible for 13% of the company's revenue. Honestly, this number is, in my view, is going to increase over time, and it's just a matter of time until we see big numbers out there. This department where Disney has been investing the most, and the launch of Disney Plus just proved that. I think it's going to grow until it becomes the most profitable segment of the Disney company. Now I want to talk about you guys and express my thoughts on this whole situation and actually see the impact on Disney business itself. As you may know, the global disease had hit our planet just finished in 2019, has been destroying pretty much all the businesses in the world. Disney is not an exception. Disney closed all the parks and cruise lines experiences for indeterminate time. Also, they stopped filming, closing all the studios last week, and all we can do is wait and see, because there is no form to predict whether they will reopen next month, 3 months from now, or 4, or even a year. It just depends on the disease situation and see if it is actually safe to go out there and to restart the normal conditions. With that being said, Disney probably this year will fail on the expected revenue. I think they will struggle a lot, mainly on the parks and experiences department, due to fear of people going there, even if this whole situation calms down. My conclusion is that Disney is for me a stock to watch right now, and I really need to see if it becomes the real deal. I think Disney will surpass comfortably this situation, but they will need to manage the business very well and cut all the expenses. I think they might cut the dividend for a little while, but with the long term perspective, Disney could really be a good investment. And with that being said, I think this will end the video. I just want to say that you guys, in order to invest in these companies, you really shouldn't trust on my word. All of you need to do research for yourself and find your reasons when investing in these companies. Peace.